Hello and welcome to the November edition of my market newsletter. I just keep finding there's an abundance of noise and confusion in the financial markets, and that because of this, I've created this newsletter where each month I put together a summary of thinking to help educate long-term decisions. Now, before I get started, I do want to say because of the increased regulation and compliance in my industry, I want to start with saying everything in this newsletter is based on my opinion, is not predictive in any way. All right, now with that said, in this newsletter, we're going to cover updates from the Federal Reserve, progress in the U.S.-China trade talks, and then thoughts on market volatility. And at the end, I'm going to go into detail on long-term market return assumptions. This is going to be more expanded than what I normally go into. Now, as always, here to help, here to discuss. If you have questions on this, feel free to reach out. All right, so the first thing is looking at the Federal Reserve's, the latest rate decision. So, last week, or I should say now 2 weeks ago, the Federal Open Market Committee, the FOMC, met, and they decided to lower the federal funds rate by 25 basis points. All right, so 0.25%. Now, as a reminder, this federal funds rate is not the rate that you borrow at, but this is the rate that banks charge each other. So this lowering brings the target range to 3.75 to 4%. This is the second consecutive cut this year, followed by a 50 basis point reduction in September. And it does represent the lowest benchmark rate in 3 years, as you can see on the chart in front of you. But it's interesting. It just doesn't feel that way, at least not for me, at least not for most of the clients I work with. But the decision reflects the Fed's ongoing efforts to support economic growth. All right. Now, something to keep in mind is that this vote to lower rates was not unanimous. There were two dissenters preferred to hold rates steady, signaling caution about the pace of easing and cutting rates. And that federal chair, Jerome Powell, emphasized that he's going to continue to be data dependent going forward, right? And some analysts think that we could have another cut, in a month or so in December. Now, the Fed also announced it will finish its balance sheet reduction, right? This is called quantitative easing on December 1st. So this is a little bit of inside baseball here with quantitative tightening is what they're going to end. And that quantitative tightening or easing is some inside baseball in my world, in that if this occurs, all right, if quantitative tightening ends, if that occurs, it's going to add more liquidity to the markets. And that, assuming that happens, that commonly leads to lower interest rates. And then, of course, lower rates generally support borrowing, business investment, stock market performance, all because we're reducing the cost of capital. Now, however, with inflation still above the Fed's 2% target, the Fed is likely to have a measured approach with adjustments rather than aggressive cuts. Now, as for me, if you're interested, I kind of like this lower response. It doesn't mean I like higher interest rates for borrowing. It just seems like this is the less risky option, right? So we're going to, of course, continue to monitor the trends, adjusting portfolios as needed, to prioritize your long-term investments when it comes to investments, your long-term goals when it comes to investments. Now, the next item is going to be looking at the U.S.-China trade talks. And really the idea here is this is, stepping towards stability, right? So the early thoughts on this is that, the U.S.-China, the trade looked to be optimistic. President Trump and President Xi in China, they had a high-level meeting, and the two nations announced a historic trade agreement aimed at de-escalating tensions. There's going to be tariff relief. The U.S. looks to be pausing certain reciprocal tariffs on China for another year, halts plans on 100% tariff on Chinese exports to third countries. This should help prevent disruptions to global supply chains, really looking at China, autos and technology. Next is critical minerals. China agreed to lift export restrictions on key rare earth, minerals and elements, really looking at semiconductors and renewable energy. There's an ag commitment. China pledged to purchase a whole lot of soybeans. That's going to help American farmers a lot. At least I think it will. And then, of course, some other areas looking at fentanyl. Of course, that's an issue. U.S. chip firm investigations, reciprocal visits in 2026. End of the day, trade is tough. Okay, it's hard to balance what should be imported at a lower price, like from China, and what should be produced domestically, typically at a higher price here in the States. So this is always going to be a tough balance. Now, overall, I see this agreement as a temporary calm as opposed to a long-term, rock-solid game plan. The reality is that the U.S. and China are two of the largest economies, and both countries need to act in their own best interest. Broadly, the equity markets responded positively. Now, keep in mind the not knowing of future outcomes is one of the core reasons why we continue to have a diversified investment strategy. Great. Now, next up is looking at market volatility. End of the day, I think this is going to continue, right? The most common question I hear from clients is, do I need to be concerned or am I on track? Okay. We all need to embrace the truth that these answers are always unknowable. These are. Unfortunately, even the experienced investors and clients can miss this reality, right? At present, the world is full of economic unknowns, right? In this newsletter, I already highlighted the interest rates, trade with China, but something else on China is the reducing population. When you look at prior powers that are on the downward slide, and China might be, this has caused some significant geopolitical implications, right? You look at Germany in 1914, Japan in 1941, more recently Russia in 2022 invading Ukraine. More on Russia is that the population continues to drop. People are not wanting to migrate into Russia, right? It's creating this sluggish economy. I'd even call it a completely destroyed and hollowed out economy. I really don't think that the news, coming out of Moscow is reflective of what's happening on the ground. Now, hopefully, all this pressure is going to push Putin towards talks as opposed to lashing out, right? Now, in the U.S., we have our own set of problems. Heck, the government's been shut down for how long? I've lost count. Federal entitlement programs continue to grow at an unaffordable rate. Federal borrowing, if unchecked, is on a path to being unbearable. And the U.S. doesn't have a whole lot of options to solve this problem. There's probably three, all right? The most favorable option would be to grow the economy and grow ourselves out of the problem. Unfortunately, I personally don't have a lot of faith in our politicians that we're going to be able to grow our ways out and not spend to match the growth, right? The next option is going to be reduce entitlement programs. But again, I don't have faith in our politicians to pull that off. The last option is unfortunately probably the most likely. I hope we don't do this, but that would be to inflate the US dollar, right? And hopefully we don't go down that road. Now, what's more, thinking of market volatility, the S&P 500 now has historically high valuations, as you can see on this chart. We're now at 22.9 times forward earnings. Feel free to pause and look at this. And then, continued on that vein is that the Mag 7, Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla make up about 37% of the S&P 500 total market cap. Again, a lot of data on this slide. Don't hesitate to pause and review this chart. Very busy. A lot of good information on here. So what am I saying with this? I'm saying the equity markets have historically been volatile, right? And they'll continue to be volatile in the future, right? In this next chart I've put in here multiple times, but this is why, is that, here are the average intra-year declines. And you look at 2025 and the year's not done yet, right? But we were down 19% at one point during the year, and we're up positive 16% on the year, right? And you can look at each of these years, and it's very odd you don't have a down year, right? You have a 0, a -1, a -2, -6, -7. I mean, typically you have these much larger downward pulls over the course of the year. All right, now, kind of wrapping this up, right? In a world of constant headlines, remember, your plan is designed to withstand volatility, not predict it. Okay, we can't predict that. Now, the recent Fed cuts, U.S., China, that underscores opportunities and, of course, challenges as well. If you want to talk more through this on your portfolio, please reach out to me. I'm going to pivot into this additional data section and really try and target the long-term capital market assumptions. So this is, I think, really interesting. Recently, in the past month or so, or 2 months, firms like JP Morgan, BlackRock, Fidelity, Capital Group, SSGA, Franklin Templeton, others, have all come out with their long-term market assumptions, right? And if you're curious, the companies I listed in name in total manage close to $30 trillion. My guess is they have awfully good research teams. Now, if you do a research, for information on long-term capital market assumptions or on any of those companies, and I'll highlight some of them here, you'll find a slew of data, almost all of which show a slowing down of future investment returns. So let me hit on this, and then also I want to compare this to a report I found from 2010. Now, finding that report from 2010 certainly took some doing, and I also have shared that link in here if you want to see it. But let me just do a quick highlight here, and then I'm going to walk through what some of this actually means. So, JP Morgan, they issued this in November. You're going to see U.S. large cap equities. So for the next 10 to 15 years, these are all typically 10 to 15 years. I think in one there's a 20-year estimate. They're looking at forward returns of 6.7% before inflation. Okay. Now looking at Franklin Templeton, again, they have a 10-year. U.S. markets, 7.2. So what do we have? 6.7, 7.2. Let's go to BlackRock. U.S. equities, 20-year return, 6.4. SSGA, State Street. Let's see here. 10 years, 6.3. Okay, you're starting to see a trend at this point. Capital Group, 20-year, 6.3. All right. Fidelity. Let's see, this one's small. U.S. equity, here we go, 3.2. That's after inflation. 5.8 before inflation. If you can see that one's small. All the links are in here if you want to see this. But here's what I thought was interesting. I'm like, all right, well, what's the furthest back, what's the most historic one I could find? The most historic one I could find was from JP Morgan back in 2010. And so, again, this one's small. Let's see here. U.S. large cap. Growth assumption over the next, 10 to 15 years, 7.75% return. So, all right, follow me on this. This came out in 2010. This was starting in calendar year 2011 going forward. And so, the jury's in at this point. Okay, we're 15 years past. So the question is, all right, well, what type of rate of return did we actually experience over this period of time from 2010 over these past 15 years? So if I'm looking at November 1st, 2010 to October 31st, 2025, right, you can see this annualized return of 14.4%. Not only was JP Morgan wrong, they were dead wrong, almost, half under what the returns actually were. Now, am I saying this is going, these are all going to be the case on a go-forward basis? No, this is just like I was saying before, no one knows the future, only God does, right? And I don't care how many trillions of dollars these companies manage, no one knows the future. We just don't have it. All right, so I just wanted to hit on that. All right, separate item, I'm a big debt, by this point, everyone knows I'm hyper concerned on debt. I do see this being a big potential issue. This chart's interesting. Doesn't matter if you're a Republican or Democrat. The national debt since Carter has only shown to go up, right? It's this idea that both parties agree, let's just pass the buck on to future generations. We'll see how this pans out. And then two other data points I like sharing. One is looking at the 5-year break-even inflation rate. We're at 2.35%. Yeah, this is higher than the Fed's 2 measure, but man, it sure looks steady. The last chart I like to look at, is the interest payments on government debt. I mean, $1.1 trillion is just a huge figure, right? My guess is that we need to lower the debt in this country, but of course, no one's asking me. Got it, right? So in closing, and as always, we can't control what the market does from here. We cannot predict when the next market downturn will occur, but we can control our behavior in response to these outside events and then continue to stick with our long-term strategy. As always, thank you for your trust. If you have any questions, please contact me. Hope you're great. Talk to you soon.